Hello, everyone. I'm Alice Shakina. I'm a divorce mediator, and I'm very excited to have my friend and colleague Phil Galante here today. Phil is a mortgage professional, and he's also a certified divorce lending professional. Phil, welcome.
Thank you, Alice. Great to be here.
And I would love for you to sort of explain, just as an intro, why someone should look to use a certified divorce lending professional when they're going through a divorce versus a mortgage professional who does not have that certification.
Sure. Well, we're trained in various aspects of divorce lending. It's a subspecialty of regular mortgage lending, and some people are perfectly served by a regular mortgage broker. I did several divorces before I became a certified divorce lending professional. Before I took the course and got a certification and joined the Divorce Lending Association of America. But something that was frustrating for me was a lot of times I would get referred someone after a divorce is completed and they'd say, okay, I have to buy the home within 3 months or we got to sell it. And I'm like, okay, well, let's go over your income. Are you receiving support from your former spouse? And I said, yes. Okay, were you receiving it during the divorce? Yes. How were you receiving it? Oh, well, it was just deposited into a joint account. Well, we can't use that for qualifying income because it was just deposited in a joint account. In order for I should backtrack a little bit. For a mortgage lender to look at support, either spousal support or child support, as qualifying income for a mortgage, you have to show 6 months receipt and you also have to show 3 years continuance. So, and you show 6 months receipt, there are certain rules around it. It has to be the result of an order. So if one spouse was just depositing money into a joint account without an order, we cannot count that as cannot count that as qualifying income. If, however, there's a temporary order in place during the divorce, we can get that 6 month clock ticking. We can get that clock started, but it also has to come from one separate account into another separate account. It can't be just deposited into a joint account. So that's just like a little something in terms of the mechanics of mortgage guidelines that a regular someone who's not been trained in divorce lending might not know. Another example is just knowing some of the mortgage guidelines. One of the clients you actually referred me bought his ex-wife out, and his existing lender, which was a bank, quoted him a much higher rate than I did because he was taking equity out of the house to pay off his ex-wife. Well, this is called an equity buyout in mortgage parlance, and so you actually get a lower rate. You get the rate and term rate, even though you're taking cash out of the house. So when you take cash out of the house, there's more risk for the lender. So usually there's a higher rate. But when one family member buys another out, like when a brother or sister will buy their siblings out if they're both on title, or when couples are divorcing and one buys the other out, you actually get the lower rate term rate if you can prove that instead of the cash out rate, which is higher. So I'm sure that the bank that quoted him the rate did not know that whoever was working at the bank did not know that rule or did not know that guideline and quoted him the cash out rate instead of telling him the lower rate term rate for an equity buyout. So sometimes it's just simply a matter of knowing all the mortgage guidelines. Other times it's knowing some of the mechanics. And then there you get into more advanced things like helping plan and helping the mediators or helping the attorneys come up with a settlement. So let's say, for example, I'm just going to use round numbers. Let's say you have Jane and John Doe. They're getting divorced. Jane gets awarded the house, which is $1 million. Again, I'm just using round numbers. And John gets awarded a savings account with $1 million. So that would seem to be equal and fair, correct?
Right.
Because
On the face of it.
they're both similar value. But you also have to think about you have to take other things into account. So you have to look at the cost basis of the house. So say the house cost them 500,000, they bought it and it's now worth $1 million. Well, if Jane decides to sell it for $1 million, that's 500,000 in capital gains. So she deducts, I think you can get 250,000 of that. So there's still $250,000 of capital gains, and if that's taxed at 25%, that's $62,500. Whereas John, having the savings account, can use that money freely. Does that make sense? So,
Absolutely.
so you want to try and make this as equal as possible for the two of them, and just looking at it on the surface, they might not take that into account. Or the other thing is to offset some of that. She might be able to take instead of a standard deduction, might be able to itemize her deductions and take a mortgage deduction if there's a mortgage on the house. So again, that's not exactly an equal split, even though they're both nominally worth $1 million. Does that make sense? What I'm saying?
Absolutely. Yes.
Cool.
So basically, on the face of it, it looks like it's the same, but it's not because of capital gains, because of taxes, all
Yeah.
those things, right?
Right. Exactly. So
So
there are a lot of things to take into account when structuring the settlement for the divorcing couples, because most divorcing couples that own a home, their largest asset that they own together is going to be the house.
So let me just ask a little bit about how you work with couples. So let's say they come to you early on, right? They're
Yeah.
just thinking
I,
about getting a divorce. They're trying to determine what they want to do with the house. Do they want to keep it? Do they want to sell it? Do they want to do a buyout?
mhm.
And so it's my understanding from what you're saying is that you can have a consultation with them to talk through some of the different scenarios to determine, like, if you do this, this is what would happen. If you do that, this is what happened. Is that right?
Yeah, I usually have like some questions, ideally some questions for them to answer before we talk, just so like, value of the house, are you going to be receiving support? Uh, does one or both of you want the house? Are you intending just to sell it and have some sort of settlement? And you need to be able to qualify afterwards. So I have a list of questions for them to answer. Just helps guide me and helps try to figure things out, without getting too into the weeds in terms of numbers, just so I get a general idea, at least on the initial consultation. And sometimes it'll be a matter of just like listening. Sometimes I'll talk to one and they'll want to vent, um, and they're different. They're different. The first conversation, the initial conversation I have with people differs, but I like to get at least an idea of their situation, where they are in the divorce, and what their intentions are, and what their most desired and ideal outcome is, and what then from there we try and figure out numbers wise what's realistic, and hopefully get an introduction to their mediator or their attorney or their financial planner, just to help figure something out for them and help sort things out.
So I have a question regarding something that you said earlier. I heard you say something about in order for support to be considered for the mortgage purposes, that you have to
Qualify
have an
Qualifying income.
yes,
Yes.
that you have to have an order. So if people go through mediation
Hmm.
and they don't have an order because they mediated their agreement to say, I'm going to be giving you this much spousal support, what is the ramification of that?
That's more difficult. Some lenders, you can just use an MOU, a memorandum of understanding. Others want to see an actual order, even if it's a temporary order. So it's going to vary from lender to lender, because I'm a broker, so we're able to work with many different lenders. But for the most part, they're going to want to see an order. Some will use an MOU.
Got it. Okay, so sometimes that might suffice. So
Yeah.
they should basically ask, who should they be asking whether the MOU is sufficient? Like, sort of, what's that look like?
Sufficient. Yeah, I mean, if they're thinking about doing something soon after the divorce, it might be worth their while to hire, uh, even if they're doing, the mediation, just to hire an attorney to specifically do an order, a temporary order, just to get that clock ticking, and then to do one afterwards.
Okay. That's good to know.
Mm.
And at what point is the best time for people, if they're going to do a buyout or sell, is it best to do it like before they divorce, like before they file, or during or after? So what does that timeline look for
It's
people?
it's going to vary. I mean, it ideally it's good to get a certified divorce lending professional involved as early as possible to help them figure these things out. Um, the thing is there are all sorts of tax implications in terms if you are not itemizing if you are itemizing your deduction, if you're not taking the standard deduction and you're itemizing, if you're taking a mortgage deduction, during the divorce, if one's occupied and the other isn't, you have to look at that. Then you also have to look at what the tax implications are, because if you divorce, say you divorce in March, how do you divide the property taxes? And one occupies the house and one doesn't. How do you deal with the property taxes? A lot of times people won't divorce until like the very end of the year, as you know, because tax wise, if you divorce during the year, that's, you have to file separately. Whereas if you wait till the like December 30th or 31st, you're still considered married tax wise for that year. So you have to take that into account. So there are a lot of different variables. Most of the time, people that I work with, they don't do anything in terms of buying or selling until after the divorce is finalized. There are different agreements. I've worked with different people how they agree to share the house during the divorce, or if I've had cases where they co-own the house during the divorce. Each one has their own apartment and they rotate. That's mainly for this, like when there are children involved. You have others where one's occupying the house, the other's renting a place temporarily, but they're splitting all the expenses. But when you do something like that, if you are taking a mortgage deduction, there's no deduction for rent, but there is a mortgage deduction. So you have to figure out how you're doing all of that. So there are a lot of factors to take into account.
Okay, so really it just depends case by case,
It's
right?
case by case. Yeah, I wouldn't say there's like one best time. I'm again, that client that you sent me um, was still technically married, and his buying her out was a condition of the divorce being finalized, and so most lenders will want to have the MSA before they will finalize, before they'll actually lend on the property. But in this case, I was able to argue because he had been paying her sort of monthly rent for occupying the house solely. I was saying that I said to the underwriters, and we had the MOU, the memorandum of understanding. I was able to argue the underwriter said, well, his liabilities will actually go down as a result of the divorce being finalized. And they agreed. And that's why we were able to do that one, the buyout, before the divorce was actually finalized.
Now, speaking of that, that brings me to a point that is frequently a question. Can you talk a little bit about the filing of the divorce
Mm-hmm.
and how does that, if at all, impact the ability to refinance?
Yeah, I mean, it was so when you do file, a lot of times that puts in the what is it, the temporary. I'm drawing a blank on the term right now, but that can all your bank accounts are frozen,
Yep.
and that actually can impact that. So a lot of times you won't be able to refinance, especially if one's occupying and the other isn't. There can be all sorts of um, there could be all sorts of implications once you do file. So a lot of times, before someone's even filed, they'll start a refi. Right now, it's rates are so much higher than they were. That's another thing that we take into account. Something I should say that we take into account when we're trying to settle things. If people had like a low rate, like 3% or 3.25% to buy, and then they have to buy the other spouse out. They're not able to do an assumption necessarily. Then you're looking at something in the high sixes or low sevens for a 30-year fixed. So that's an implication. But yeah, once the divorce is filed, there is that freeze, and that makes it very difficult to do so. And again, you can do it in some cases, like I did with your client, because they had filed, the divorce had not been finalized, and like I said, I had to go through it with the underwriter. So uh, that's something we had to take care of. But that was like an individual case.
Right, right. So I guess it depends. Like people really need to be careful and maybe talk to a divorce lending specialist
As soon as
before
they
they
can.
file,
Yeah.
so that they can at least get,
Yeah.
a good reading on what they need to do. Because it
Yeah.
sounds like the two best times would be either before you file or after it's finalized, and
Yeah.
then the gray area is during the actual time that the divorce is pending. Is that correct?
Yes, exactly.
Okay. All right, that's good because I usually tell people be very careful if you're planning on a refinance. Uh, be careful about filing, right? Because that can impact it. Is
Yeah.
there a difference, Phil, between what you as a mortgage broker can you see a difference between um, how banks treat someone who's in the middle of a divorce versus private lenders when they're going through a divorce?
Um, like I said, I've been on both sides. I worked for banks for 13 years before I moved over to the brokerage side. In general, a lot of there's a lot more flexibility. Um, there's a lot more flexibility because a lot of the underwriting guidelines for the wholesale lenders will be not as stringent as the ones the banks. So that's just in my personal experience. I worked for three major banks doing loans for them. Um, so I think that a lot of times they can find a better. They might not necessarily always find the best rate, but they'll be able to find something that'll handle their situation. And then the other thing is there are all sorts of specialized lenders that do what are called non-QM loans or non-qualified mortgage loans. So this might be for someone who owns their own business. It might be a loan instead of based on traditional underwriting standards. They're going to look at 12 months or 24 months of bank statements. There are asset depletion loans. There are all sorts of different types of loan products that we can offer that a lot of the banks don't. And don't get me wrong, I'm not one of those brokers that puts the banks down. A lot of the banks do a great job. Um, but I think for what I'm doing with the divorce lending, being a broker is more advantageous.
Okay, great. And I also wanted to, you mentioned a word in passing, but I want to bring it up a little bit so that people can learn a little bit about loan mortgage assumptions. So
Hmm.
if you could explain to people, A, what that is,
Yeah.
and B, how difficult or easy it is if someone is trying to do that.
Yeah, mortgage assumptions are not easy. I mean, so actually, I spoke to someone last week, and I said, well, one of the things you can do is look. So an assumption is basically when you say you have two people on a mortgage, a husband and wife, or it's two spouses, and they're getting divorced. An assumption would be if one takes over the mortgage completely and the other one is removed. But the thing is, you have to understand that when this happens, it's rare because first of all, especially for people that have low rates, like at 3 or 4, even 4% compared to now, like in a 6 or a 7, lenders are going to be reluctant to let one person assume that rate when they can get a refinance at a market rate that's higher. The other thing is when people qualify for those mortgages, um, they're underwritten as two people and maybe as two different incomes. So when they're doing this so when one is assuming the loan, it has to be re-underwritten. I've actually talked to one person that is actually going through an assumption right now, but it's an exception it's the only time I've ever seen one go, and I don't know if it's actually going to happen, but they're doing it. But also, this person has a lot of assets under management at the same bank because it is a bank loan. They're doing a lot. They have a lot of assets under management at this bank, and I think because of that relationship, they're willing to look at the assumption. But in most cases, that's not possible. So What I do see is, everyone's trying to do that, and something that I tell people is like, if you have the closing disclosure from the last loan, a lot of times it'll say on the closing disclosure there'll be a section and it'll say whether or not the loan is possibly assumable, but it'll always have language that say this is at the lender's discretion, and 9 times out of 10, in my experience, they're going to say no.
Okay, so then if people are thinking about that, the first thing they should do is contact their lender and ask
Contact their
if,
existing lender and see if that's a possibility.
okay,
Yeah.
okay, great. That's good to know. And what else would you tell people about like mortgages, refinances during a divorce? What sort of advice would you give people?
One thing that comes up frequently are the appraisals, because there are two main type of appraisal reports. There is the general purpose appraisal report, which is often used for valuation in a divorce, and then there's the URAR, which is a type of appraisal report that lenders use to evaluate the home for a loan. And where we see problems arise sometimes is when someone will use the value of the GPAR to set a value of the home for the divorce. But then when it comes time to refinance afterwards or get a loan and they get an appraisal, that the URAR goes more in depth and it's more detailed. It's something the lender uses, and it might catch deferred maintenance or other problems with the house, and there'll be a big discrepancy in value between the two appraisal reports. And so, it's people use different appraisals for, or different ways of valuing the house for divorce purposes. Sometimes they'll do a CMA or comparative market analysis from a realtor, and that's actually a good thing to use if they're going to them if they're intending on selling it immediately or during the divorce. That might be a better way to go than the GPAR or the appraisal report. The problem with the URAR, the which is the loan that the lenders use, because it's for a specific purpose and it states that in the appraisal report, it's for the specific purpose of lending. It cannot be used as part of the divorce settlement. So that's something for divorcing homeowners to be aware of.
Oh, interesting.
Yeah.
So, so should they just be asking for a specific one when they're going to get an appraisal done?
Well, no, because you cannot use the URAR for divorce purposes to evaluate the house. You have to have the GPAR or comparative market analysis. Because, I mean,
See.
yeah, because the URAR is specifically for lenders, but a lender is not going to use the GPAR either. So but it's something to be aware of. Because like for the GPAR, a lot of times the appraiser will just do a drive by or just use comps, whereas the like for the CMA, the realtor will again mainly look at comps. And the other thing that you have to think of is for any appraisal, you have to look at that as it's just sort of like we always say it's a snapshot in time of the value of the house. In terms of if you're going if you're going to put it on the market, it's worth whatever anybody's going to pay for it. But the lender depends on the appraiser to come up with an educated opinion of the value at that time, and that's why appraisals have a time limit on them. At least the URAR does, and that's also a problem in very long, drawn out divorces. Sometimes I'll have to do more than one appraisal, because especially if market conditions are rapidly changing.
Now, if you have a couple who are divorcing and they're debating whether they want to pay for an appraisal or if they just want to go get some comps from a realtor they know,
Mm-hmm.
what are the pros or cons or shoulds or shouldn'ts regarding those things?
I think like if they're going to sell the house immediately, or and they need to get a value, I actually think that getting a CMA is actually something. It makes sense if they're going to sell immediately. If they're going to need to if one of them's going to have the house, or they need to have an evaluation of the house just for the purposes of the divorce, for the settlement, trying to figure out who gets what, the GPAR is a better idea, but just have to understand that there might be discrepancy in value between that and what happens when they try and refinance the house.
Oh, interesting. Okay. And then is there any reason why they should or should not disclose if they're getting an appraisal, right?
Mm-hmm.
That they should or should not disclose that it is because they are about to get a divorce. Let's say they're just doing this prior to filing. What happens if they do disclose? What happens if they don't? Like
To
what
to a lender or to an appraiser that they hire?
an appraiser? Because
No,
does that change? Does that change the
it
numbers when they come back?
it really shouldn't, because a lot of private appraisers are used to doing these for divorces.
Okay. So it doesn't matter.
Yeah.
All right, got it. Well, this has been really great, Phil. Thank you so much for giving us all this information, and hopefully the people who are getting ready to exit their marriages and have to handle their homes and what to do with it,
Yeah. I mean,
will get great value.
it's a difficult time, and I think one of the things that's rewarding for me about doing this, it's being able to help people with oftentimes their largest asset in this difficult time, and it's it's not something that people often think of while it's happening, because there's so many other things to think of. But shelter is a pretty important part of life, and unless you're so independently wealthy where you can pay cash for a house, financing's an aspect of that.
Yes, definitely. And I know it's really difficult when someone wants to desperately to keep the house, whether it's because it's their childhood home or it's because it was passed down to them, or maybe just for the kids' sake.
Yeah.
And then they suddenly can't afford a refinance and they don't have the cash to just buy the other partner out. So, are
It's
there alternative things that they can think about from your perspective in the event that one
yeah.
person cannot qualify?
It is that's a discussion I've had many times. It's very emotional because people, I mean, people are attached to their homes. Their kids may have been born there or grew up in the house, or the kids still want to live there. And a lot of times, especially with interest rates being higher than what they were, it's too hard for one of the two spouses to afford it on their own. And there are things that I've done with different people that have really wanted to keep the house. We've added like a relative as a co-signer, but you have to find someone that's willing to be on the loan. And then there's always the question of, well, is that person also going to be on title? Because it's a terrible position for someone to be on a loan and not be on title.
Yep.
And I have had family members who have been willing to do that. So that's something that can happen. But it is. But I tell people, I said, look, is it worth being in this home if you're eating instant ramen every night because you can't afford to do anything, or is it worth never going on vacation again for 5 years? Are all these things worth? Think about your life and your lifestyle. Is that worth it? You know, um,
Yep.
that's an important consideration. And just having, and the thing is, a lot of times, lenders will approve a loan, and I'll have this talk with people, said, can you afford this? Because I know that you also have kids in private school and tuition does not show up on your credit report. So even though the lender says that, your debt to income ratio is in line, is it really? Because I know you have these expenses. Is that worth it? Can you do this? And, unfortunately, a lot of times the answer is no. And that's really, sometimes it's a heartbreaking discussion to have with someone who's been in a home for 5, 10 years even, and raised their kids and their family there and have a lot of memories that they can't keep the house afterwards.
Right. Well, you're a really empathetic person that they have to talk to. So thank goodness for someone like you, Phil. If someone wants to, get some advice, and they're about to head into a divorce, do you do free consultations?
I do. Yes, I do have a free consultation.
And how can people get in touch with you?
My email is Phil, Phil, at promortgage, PROMORTGAGE.com. And phone number is 415-798-6637.
Thanks so much, Phil, for your time today.
Thank you, Els. Thank you for interviewing, and thank you for your partnership. I've really enjoyed working with you.
Same. All right. Thanks.
Thank you.